Welcome to Venture Podcast, presented by VNTR, the world's leading investors community, the place to learn from VCs and capital allocators.
But the math shows that in order to take advantage of the asset class, you need diversification to get to be about 20 to 25 deals. So as an investor, what you want to do, and what I saw and what drove me to keep investing, even though it was little bits, is look at your total portfolio, figure out how much you want in this high risk, high reward asset class. And if it's 100 grand, you divide that by 20 or 25, and you make $4,000 or $5,000 bets 20 to 25 times across industries, across time, so that you get diversification where you're going to hit, maybe you hit a Google. I mean, those are rare, right? It's what got, our 200 million AUM in place, but there are other elements.
Hey guys, welcome to VNTR podcast. We are here today with Kelly Perdew, general partner at Moonshots Capital. So nice to meet you, Kelly. Thanks for joining us. We would like to, learn more about your investment journey. And Nico Leon is joining me today to have this fruitful conversation. Nice to meet you. Please introduce yourself and share some of your background.
Well, hello, Yuri and Nico. I really appreciate you having me on. I love talking to entrepreneurs and new and experienced investors alike. I hope to help both those categories of people learn from my mistakes. So I hope that I can do that some today. My background, I think I'll start kind of college. I'm old; it would take a long time to go through all of it. I graduated from West Point and the Military Academy of the United States, and went into the Army as a second lieutenant, military intelligence officer. Got both airborne and Ranger qualified, and then my first duty station was the 7th Infantry Division, Light, and I stayed active duty for 3 years, learning a lot about leadership, leading troops, and then did reserve for 2 more years and started a JD MBA program at UCLA. So it was in that program that I got my first taste of the entrepreneurs around, the investment, all those different things that occur in and around the business schools. And that bug bit me hard. So I started my first startup while I was in that program. I have since been an operator in 10 different roles of 10 different businesses, 6 exits, 2 learning experiences, right? Those that, the things you kind of screw up or don't go well. And then 2 that are still outstanding. The jury's still out, but are cash flowing, and we'll see what happens. And along that path, as I met the other entrepreneurs in the Los Angeles ecosystem, I got very energized. And coming from service, coming from the military, I looked at and still look at entrepreneurism as the lifeblood of the U.S. heart of the economy, and helping entrepreneurs succeed really appealed to me. And initially, I only had a couple extra nickels for investing, but I also had some time. So I started investing both some of my extra dollars as well as my time in advisory roles or board roles, mostly in finance and business development, where I had a pretty large network and enabled me to help them kind of make it to the next level. I evolved my angel investing to the point where I was writing, $25,000 checks, $50,000 checks, and this was a long time ago. I started doing that in 2004, so 20 years ago. And my mentor had given me this from an investment standpoint. Luis Villalobos, he was the co-founder of the Tech Coast Angels, which is a very large angel group along the west coast of California, and the Angel Capital Association, one of the founding board members for the Angel, and he helped get off the ground DC Angels and New York Angels. So this guy's a real mensch. And he had done Monte Carlo simulations, a math wizard, on all of the early stage investing that was occurring, angel tech and high tech, highest return of any asset class at the time. And he found that most angels stop investing after 2 or 3 investments. And it usually works like this. You're at a dinner or now you're at a great event, and two or
Yeah.
three, entrepreneurs pitch. So now your entire data set that you're selecting from is three people that you're picking from, and one of them is better than the other two. So you're like, okay, I'll write a $20,000, $25,000, $50,000 check, because you're a dentist or a doctor or whatever you are. You made some extra cash flow and you're like, love watching TechCrunch with these billion-dollar companies coming out all the time. And you want to get a piece of one of those. And you do that two or three times over 2 or 3 months of going to a dinner or watching a pitch session. And inevitably, one of those companies goes out of business. And now a significant other or spouse gets involved and goes, what have you done? That's a whole college education, because there's like 75 or 100 grand out there
Yeah.
and one of them's gone. And they stop investing. But the math shows that in order to take advantage of the asset class, you need diversification to get to be about 20 to 25 deals. So as an investor, what you want to do, and what I saw and what drove me to keep investing, even though it was little bits, is look at your total portfolio, figure out how much you want in this high risk, high reward asset class. And if it's 100 grand, you divide that by 20 or 25, and you make $4,000 or $5,000 bets 20 to 25 times across industries, across time, so that you get diversification where you're going to maybe you hit a Google. I mean, those are rare, right? But you at least start to see the opportunity for things to occur. And there are so many deals in the world right now that it's easy to get access. The thing that you're going to struggle with as an angel is someone like me running a venture fund. For our fund 3 now, we've seen over 2,000 deals and we funded 8. So we have pattern recognition, we have expertise in certain areas, we know how to evaluate the founders and the business models. And if you're just starting out, it's really hard to be able to do that, and you're basically going to get lucky, or you work in an area that you already know and understand because that's the business that you come from. So that's what led me to start doing, firing. I wanted to get 20 to 30 arrows flying to take advantage of that asset class, like my now deceased mentor, said that was the right way to do it. And it's grown to the point now where we moved to syndicates from angel investing. My business partner, and he's also a West Point grad based out of Austin, to running a fund.
That's really interesting. And looking at your LinkedIn and a bit of your background, I think I saw over 100 different experiences. I don't think I've ever seen a LinkedIn with that many kind of items on it. But just talking a little bit more about your investments. I mean, you've been investing for, I don't know, 20 years or so, you say. What have been your biggest success stories? It was great to know about that.
So there are a lot of different ways to define success. As an investor, you're typically looking at return, right? LinkedIn was a very successful early stage investment for me. Scopely was a very successful early stage investment for me. Some people might not have heard of Scopely. Walter Drivers, the co-founding CEO, I met him, put money in the seed round, acted as advisor for a short while. About a year and a half ago, it exited at 4.4 billion, all cash, as a gaming platform company. And if you can find those, you should definitely invest in them. But we can get into how you make decisions on who you want to invest in and why. Right now, one of the companies that I feel when you say most successful, in addition to capital return, I also think about the mission of the company. And I invested now 13 years ago and have been on the board for 12 years in a company called ID.me. And it's an online identity platform run by a military veteran, founded and run by a military veteran, Blake Hall. And they've now credentialed over half of the US adult population, so 130 million individuals, so that people can verify they are who they say they are when they're accessing different types of services. From the consumer side, all the way at one end, from getting a military discount at Under Armour as a large retailer, all the way to the other end of a doctor who wants to write a script, but needs to verify they are who they say they are, so that that script is properly, qualified and quantified for the type of drug that they're going to prescribe. Up to individual consumers, citizens of the U.S. logging in to the IRS, saying they are who they say they are to pay their taxes. So they have combated an amazing amount of fraud. And that's one of the big missions that Blake has as part of what they're doing as a company to stop, you know, China, Russia, Nigeria, major state actors from defrauding the U.S. government and stealing money.
Yeah. So how did you meet with LinkedIn founders to invest in early stage? And
So,
yeah,
so LinkedIn was a pretty interesting story. I hasn't come up yet in this conversation, but I took a little detour for about 18 to 20 months and went on a show called The Apprentice, which was a big reality show in the United States a while ago with now President Donald Trump was the key star in that show. And I won season 2. And as part of thinking about, as we film in the summer before the show actually airs, and then they edit the film, but the finale is live. So I knew I was in the finale, but I didn't know if I was going to get hired or fired in front of, it turned out 30 million people watched the finale. So basically half of a US football Super Bowl. And I thought about, well, what are the different ways that I might be able to monetize this? Understanding that at the time I was under an NDA and couldn't describe anything until the show actually launched and people knew I was on it. And about 2 to 3 weeks in to the show airing, I was getting, millions of visitors to my kellyperdew.com website. As part of the lead up to that, I also bought 2 of the other contestants' named URLs and told them the show never ends, but here you can have these. You should have bought these. So I reached out to LinkedIn because I was working at an offshore development software capability company based out of India. And we were working on things that were similar to LinkedIn, different products. This was really early, right? This was 2004, right? Mid 2000. Yeah. And so I reached out to the then, VP of business development at LinkedIn and said, hey, I'm Kelly Perdew from Thursday Nights. This is like episode 2 or 3, right? And I'm writing a book on, and networking is a critical component to leadership that I'm writing the book on. And I'll mention LinkedIn. I'll put LinkedIn above the fold on my website. And I'm doing hundreds of speaking engagements. And I'd like to talk about LinkedIn because I think it's a great tool. I would like to participate, engage in some way. And I was able to negotiate getting involved with LinkedIn as part of using the show Celebrity to give me more exposure. And as part of the negotiation, it was the VP of business development was Matt Kohler, who then went to be the VP at Facebook of business development and then started Benchmark. So he's a partner at Benchmark, a large VC fund now. He said, well, if you're going to do that, when you win, I was like, whoa. I didn't say that I won. I can't tell you if I win or lose or get fired or anything else because it's only week 2, right? And you can't let the cat out of the bag. And I said, he said, okay, when you're fired or if you win, we can use your face and likeness as the front of LinkedIn. And they used to have, somebody on the front, like, some of the people that you've had on the show, on the podcast already, right? Like Tim Draper or whoever it might be, that's illustrious person who uses LinkedIn and they put their profile up. So in addition to being able to engage on the cap table, I got to be the face of LinkedIn for about a month after I won the show, which helped, grow my user base.
Amazing. So it's a serendipitous investment in a way.
Yes. I mean, I had to do the outreach, and I literally spent probably 3 weeks in a room by myself with the whiteboard going, should I make a cologne? Should I have a clothing line? Should I, like all the things that, creators do now.
How to monetize. Yeah.
Yeah. How do you monetize it? Right. Because you get, shots at fame very infrequently. Right. And so I kind of went with the thing that I knew best, which is early stage technology and investing, and, knock on wood, that one worked out really well and started a good path for that investment. The other interesting piece of that is, I couldn't talk to anybody, so I had to do everything kind of in a vacuum. So I had never negotiated an arrangement like that, so I had to have an attorney, under an NDA to help me negotiating a piece of it, who didn't really know what was going on or why it happened. So,
and you ended up winning, and And that means that you end up working with Trump. Is that correct?
Yes, I worked with Donald at the Trump Organization for all of 2005 and a little bit of 2006. I stayed there until I think it was the end of February, beginning of March when my book launched. And he was gracious enough to write the foreword to my book and be a part of the book launch.
And what was the book about?
The book is called Take Command, and it's about applying military leadership principles to business. And at the time, I've done some okay things in business, but not like a luminary. And I won a reality show. So I was like, what do I need to do to add some credibility to these things that I'm pushing as really important, business principles? So I reached out to military veterans that had become successful in business and interviewed them as part of the book. And a few of those are like Roger Staubach, who was Dallas Cowboys, two-time Super Bowl winning champion, Naval Academy, served in the Navy, right? And then built up, I don't know what the final sale was for Staubach Properties, but he built up a very large real estate firm that was very well recognized. And I want to say it was 600 to 900 million he sold it for. I interviewed Ross Perot, which a lot of people might remember is the first kind of independent candidate that had a shot at running for things. Bill Coleman is the B from BEA Systems, which at the time was the first company to $1 billion in revenue. And then Pete Dawkins, who was a West Point grad. He was then vice chair or chairman at Citibank, and had won the Heisman Trophy while he was a cadet at West Point, running back at West Point. So I used the book as a mechanism also to reach out to some pretty neat people that I got to meet personally and interview, and that they would add legitimacy to these principles are effective in business and they are honed in the military.
Yeah, Nico, we should start writing a book. It's kind of sounds like we have a coach how to do it, right?
There you go.
Yeah.
I think that's a fascinating overlap, military in business, and I think there's obviously no more, I guess, emergency situation than in the military. So I think applying those kind of principles is very interesting. What would you say is the biggest, I guess, difference that you see leadership in military versus leadership in business? What would you say is the biggest difference that you could kind of point out?
So I think there are a lot of leadership skills that are literally millions of dollars is spent training a person in leadership per se, like literally in the study of leadership in the military. And then not only that, but training you how to train leadership. And that's very rarely done in the civilian sector. There aren't a lot of places. There are programs, and there's a leadership class here or there, but it's not the entire focus of a curriculum for years, and millions of dollars is not spent on it. So there's an attention to all of the different types of elements of leadership that exist. But the one kind of factor that I think permeates our investment criteria when we think about it, and about a third of our AUM, 200 million AUM, has gone into deals that have military veterans as part of the founding team. When soldiers go into combat, we're effectively trusting our sons and daughters and trusting them to, officers in the military going off into combat. And that is a sacred duty that is accepted as a responsibility by military veterans in a very specific way, right? It's very, very serious. Probably, like you said, one of the most serious things that you're trusted with, like a doctor with a patient on the operating table, right? You're responsible. You hold their life in your hands. Interestingly, military veterans treat other people's money similarly. Very, very high bar for responsibility, so that they're, I'm not saying that doesn't exist in the civilian sector. I'm just saying we have found that it's a common core tenet that when you give somebody money that's got a military background, that same service mentality in their DNA comes through when they're dealing with other people's money.
We see a lot of investors tend to invest like in super niche where they excel. It's kind of immigrants, for example. We have multiple fund managers that prefer to invest in immigrants because they have the greed, the grind to succeed. So they will kind of, even we in the hard times, they will keep going and build successful companies. Kind of course, there is a lot of failure, but there is larger percentage of immigrants succeeding. So you
Yeah,
identify that military grads, veterans can be quite successful in terms of building successful startups.
absolutely. I mean,
Um,
the obvious, attention to detail. Um, there's a higher bar of trust, especially Craig and I can do background checks and talk to former teammates or commanders to say,
mm,
do I want to be in the foxhole with this person or not? Because it is a war, right? Running that entrepreneurial gauntlet. It's, I just mentioned ID Me earlier. It's been
yeah.
12 years now, right? Like, I don't know, raise your hand out there if you've been married for 12 years. Like, I am very close to Blake, the founder there, right? Having been there for 12 years. So you really need to, think about what you want to invest in as an investor and which specific traits are most important to you. And, that military vet gets you a lot of the traits that most people say are the most important for running a startup.
And do you prefer like officers, or kind of just the fact that they served in the army is enough, or you prefer those that were kind of managing people?
It depends on what the target product or service is for what they're doing and what their capabilities are. But even like the lowest level enlisted person gets significant amount of leadership training while they're in the military, right? Showing up on time, shining your shoes, answering questions quickly, not lying, right?
Yeah.
Yeah, in any selling proposition, there's some puffery that goes on, especially in an early stage startups trying to sell vaporware to get some contracts going. Like it's a vicious cycle that you got to keep things moving. But when you're an investor and you ask somebody something, there's a high level of trust. They understand the importance of being honest. Like if you give the wrong grid coordinate for where you are because you're behind, you can get blown up, right? It's really important to be honest. It's more important than anything else that you're doing.
So again, if we go back to how you source deals, right? It's kind of sounds like there are serendipitous encounters, how you got into great deals. Some deals you got through advisory, like for example, Pandora. Why would they have you as an advisor?
I
Yeah,
was I wasn't
like
a musical genius, but I did know the founding CEO very well. We've been friends for a long time, and he saw and understood the value that I was providing to these other founders who were doing things in the LA ecosystem. So, as an investor, if you can add value, it's highly differentiated. Like I know it sounds a little crazy right now, but there is so much money available to founders like compared to 10 years ago or 20 years ago. There's massive
yeah.
different sources of capital that exist. So as an investor, especially now as a fund where we're trying to lead seed rounds, Craig and I have to show that we're incredibly differentiated on the value add. And from a sourcing standpoint, the ones that go right to the front of the pile, like I said, there's almost like unlimited deals to look at, right? You don't have enough time in a day, so you need a very sophisticated system for sifting and sorting and managing and trying to understand what the value prop is and what's defensible and why that team is really good at what they're doing. But if a founder that we've worked with before, who's out in the ecosystem building, recommends another founder to us, it goes right to the front of the pile because they've done like both direction vetting, right? They've done, oh, well, this person's going to be able to put up with Kelly, right? And oh, Kelly's really going to like this deal from the signals and the understanding of what we like to look for. So we've invested in over 200 plus founders now in our 115 companies that we've invested in, and they are a phenomenal source of deal flow. Again, hard to have access to that deal flow unless you're in some ecosystem that allows you that access. You're not going to probably find it wandering around alone as an individual angel investor.
Yeah.
So it's about kind of joining a community or a syndicate. Do you have any recommendations on how and where to find these groups?
It's interesting. I don't want to say there's a new group every month, but there's so many different ways to engage or get involved. I think that it's important for early stage first time investors to go after or try to get engaged or involved in a community where they can add value for what they're doing so they can be differentiated. So that community can be either geographically, like in Los Angeles, there's Amplify, there's Mucker Labs. There are a lot. That's a big city. And so there are a lot of mechanisms by which you can go be a mentor if you have a specific value prop, right? So, but geographically is one. Separately is in, but can overlay with that, is in an area where you have expertise, right? If I can introduce you to 3 potential distribution partners, I'm much more valuable than my 25,000 bucks or whatever it is you're going to invest as an angel. So really understanding where you can add value. If you're not that interested in engaging and rolling up your sleeves as an angel and you want to be, I don't call it dumb money, but dumb money, different large databases exist where you can stratify and look at exactly what companies are available. Like AngelList comes to mind immediately, right? They've got an ability for you to put as little as, I want to say $1,000 into a deal.
Yeah,
so you can get your diversification across that. You can sift and sort and read and see who else is investing in it and kind of follow signaling from other investors. We started our syndicates. We did our first couple on AngelList and then we moved off AngelList, but we have about 1,000 individuals who still participate with us when we run syndicates. So we went angel, syndicate, committed funds. And the reason we still have the syndicate vehicle is twofold. It allows us to continue to invest in our fund deals where our LPs want to get additional concentration or exposure because those deals are going well and we've reached the capacity of what we can invest from the fund in a single deal. And then separately, because Craig and I have been around a while and have this network of founders and other co-investors, we do get allocations to some later stage deals, Slack, Grub Market, Robinhood, that are way beyond where we would do out of an early stage fund, but I can still raise 2 million, 5 million, 11 million from a syndicate where our LPs first get advantage of that. And I know you guys are doing something similar with your group, and it's an awesome way for individuals to get investments and shots on goal going where there's another entity that's able to do a lot of the due diligence, provide that for you so you can make an intelligent decision on where you want to do.
And when you're making these decisions about where to deploy capital, are there certain rules of thumb that you follow? You mentioned, a high volume of different investments, but are there specific things that you look out for? Are there things that you particularly have red flags with or green flags? It'd just be great to understand a bit more about how you find things to invest in.
So there's kind of 2 answers to that, right? So in our first 2 chapters of life, first as angels and then as syndicates, there is not really a required thesis needed. Meaning, I don't have to operate in any specific sector. I don't have to operate at any specific level of a company, seed, Series A, wherever I could get in and have an opportunity to participate, we could do that. And our people who follow us and invest in us like that because there are 1,000 of them. They have different tastes, different times in their lives, different amount of capital to deploy. As an angel, it's a little different. As a fund, chapter 3 for us, it's a little different, right? In order for people to give us their money to deploy, we have to describe our strategy because they have a large portfolio. They need to understand what sleeve of their diversification we're covering, right? So we focus from the fund side on what we call late seed. So a company's up to $1 million in annual recurring revenue. They may or may not have had a small institutional investor or pre-seed round. They do have a product. Some dogs are eating some of the dog food. So there's some data that we can analyze and helps us de-risk the deal based on what we're looking at. Now, if it's a 1 in a million founder and or somebody we previously backed, we'll try to get in as early as possible, like pre-PowerPoint presentation, right? If we know them. And that's, an example of that is Gretel AI, right? We led the seed because we previously backed the founder. Greylock followed us in. Sridhar Ramaswamy came on the board from Greylock. He's now the CEO at Snowflake. They led the A. I'm still on the board there. I introduced Anthos Capital. Emily White led the B, and they're blowing the doors off. They're doing really great stuff, and every cloud provider uses them basically to allow a synthetic data layer to sit between the company's proprietary data, whether that be HIPAA issues or PII or whatever it might be, and still access LLMs, right? So NVIDIA loves it. All the cloud providers love it because now the customers can access and use GPUs, right? Because they've got a protective layer of the synthetic data that exists. So really timely. But the thing about that company was, one, I knew the founder from previously working with them. But two, it was 4 co-founders, all with multiple exits. They've been to and seen the movie before. They've exited. They're not working desperately at something they're not familiar with. They're working at something they want to change the world with, right? They really are swinging for billion-dollar valuation, and they know how to get there. So if you have it's very rare for an angel to get an opportunity to invest in that type of a company, because the best founders don't typically go to large angel groups, right? They've done it before. They know how it works. They tell Andreessen Horowitz or Moonshots Capital they want $2 to $20 million for their seed. They know they want to be on the cap table. They know which board member they want to be on the cap table, and they've got the vision and they understand exactly how they're going to finance the company all the way through. Those companies are typically the ones that are 90% of the top 10%. And if you don't have access to those, it's very difficult to participate. Now, IDMe is an example of one where Blake was a hunter-killer platoon leader in Iraq, the most successful in capturing or killing, the bad guys on the deck of cards, and then went to Harvard Business School, but had never run a business in his life, and was like, hey, I know I want to do something that helps the military. And it started off as a company called Troop Swap that pivoted to Troop ID, that pivoted to IDMe, and is now worth, last round of financing, $1.7 billion. And I'm expecting that to increase significantly. That's an example of finding a military veteran leader who is able to evolve with the company. So first-time founder, first-time technology founder, but he had enough of the leadership principles that he exhibited while I was getting to know him and mentoring him that we have invested in every round. I've been a board member for 12 years, and he's grown that company so much so it is possible to find those first-time founders, but a lot of the smart money likes to bet on the repeat founders.
And obviously, you've had loads of success stories, and I guess it's great for our listeners to always hear that, even the successful people fail as well. So, can you tell us about maybe a miss that you've had that you maybe wish you had invested in back in the day?
You mean a miss that we didn't invest in the
Yeah,
company?
yeah, that became successful.
So there's loads of those. Like every VC's got those. The one I'll tell you about is from when I was an angel investor, and living in Los Angeles. If anybody listening has ever experienced traffic in Los Angeles, the number one time never to go anywhere is Friday from about 3:30 p.m. till 8 p.m. And I got a lead on this super hot deal in Orange County, and the only time the founder had to meet with me and a couple other people was Friday afternoon at like 5:30 p.m. And I was like, well, I've heard about this deal from a lot of people. I should probably go. Maybe I could figure out a way to go down in the morning and spend the night. Just a lot of stuff happens in Los Angeles revolving around traffic. And I ended up not going to meet Palmer Luckey at Oculus.
Wow.
And so I didn't even do the math, but it's not a great one. There are all different types of not success stories. Another favorite of mine is and this when you get to the point, like first world problems, when you get to the point where you're having exits. So I was part of selling into the LinkedIn IPO, and then I sold as much as I could because I held it for 9 years, and I still hadn't had a lot of successes. So I had like Maslow's hierarchy of needs to take care of: food, shelter, and then I could start self-actualizing as an investor. And this is a advice, I think, to a lot of investors. But and then I had a lockup of 6 months and like a week after the IPO before you could freely trade all of you can only sell like 10% into the IPO or something like that. And about 2.5 minutes into trading, at the 6 month and 7 day period of lockup, I blew out 100% of my LinkedIn, right? And I've got like, whatever, enough money for the kids' college and house and whatever, did it all. And then literally weekly for the next 2 years, my two brothers would send me like screen grabs of the LinkedIn price that was just skyrocketing the whole time. I had sold. And I can't remember who said you can't, go broke making a profit. Well, for our founders, for other investors, you have to have a strategy and think about how you exit and what you exit when you have opportunities. And I strongly encourage people to get some returns off the table when you have those opportunities, because you do not know what the future holds. But there are also arguments for long holds, especially when you know a lot about the company and understand what they're doing.
Yeah, there was this case with Shopify as well, right? Kind of VCs that exit when they could exit, they could make another 100x later.
Yeah. Our rule of thumb is when we get to 10x of our original invested capital, we try to sell a third, whatever. And also, if you're a VC backing a company, you also have to be careful about signaling market. But it's not unreasonable to say, okay, we want to exit about a third of it. It returns, a significant chunk. We got a multiple already on it, and we're letting the rest ride. And obviously, you make independent decisions based on the information you have. If I'm a board member and know a lot about the company, that could change our decision. If we don't have as much access, it might be different.
So would you do that through a secondary? It's kind of if there are opportunities.
So there are, yes, that is one way to do it. Companies run structured secondaries frequently. Now, compared to 10 years ago, there's a pretty liquid secondary market, at least for known names, so that there's typically opportunities to do it. It depends on the company, though, right? A lot of the stock has restrictions where the company has to approve it. There's a right of first refusal for some other, depending on the class of stock. So there are technical elements to be concerned with, but yes, those are ways to get liquidity. There are also, I don't know how prevalent they are, but during the significant run-up of ZERP, there were companies that exist that allow employees, especially, but the ability to get a loan against the stock, where you get some liquidity that allows you to do stuff, and you're not signing personally on that. The company, though, still, it has to be a known name that the company has been able to evaluate it and underwrite it on their own for what it's worth. Now, you're definitely paying some big with those entities, but if you want to buy a first home and you're having a family, or you really want to diversify and make sure that you don't have all your eggs in one basket, and you've been with the company for 7 years, 8 years, and you want to get some liquidity, those are opportunities to do that.
Right. And can you share some insights into, like, you started the first fund, right? Kind of how was the transition from a syndicate to the first fund? Was it hard to raise LP capital?
It was really easy to raise my first fund. That's a complete lie. So I actually blogged about this. So I told you I went to and completed Ranger School. I did 4 years at West Point. I fathered twins. It's a lot harder for the wife part of that deal, but it was still like a lot of nights up and hardships, right? By far, the hardest thing to do was raise Fund 1. So we raised a $20 million Fund 1, and people who are fundraising for their companies have it very difficult as well. Like I told you, some of the numbers for our Fund 3. It is a factor harder to raise capital for a fund because you don't really have a specific product. LPs, limited partners, the people who invest in funds, have a very, 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 very long list for saying no, and only have a few spots, like similar to the numbers now that I just described to you from the fund standpoint. LPs have the same sets of criteria that exist, and they use much of their venture earmarked capital to follow on invest in that managers that are already in their portfolio who are coming back around for Fund 2, Fund 3, or Fund, I don't know what Sequoia is on, 20. 30. So there's an entirely different dynamic. And I wrote about that humbling experience of raising Fund One in our blog. Fund Two, we started raising right when COVID started.
Oh,
Also
good
not
timing,
easy.
yeah.
0 emails back. And then Fund Three, we started raising right as
Kind
Europe
of
ended. So it's been
Fund 3 is probably easier to raise than second, because in second you still don't have enough performance to show from the first one, right? While the third
Yeah, so
one, there is already kind of quite good, hopefully good performance on the first one that you can pitch to potential new LPs.
I stopped writing how it was to raise each fund because of how depressing it was to write those things. So I'll just say, running a fund is not for the faint of heart.
Okay.
Grit comes in super handy for fundraising.
What advice would you give yourself if you could go back in time and give yourself some advice before Fund One? What would you kind of say?
I honestly don't know that there's an easy way to do it. It is selling. So all of the events, the event based, the activity based. I got to do 20 emails. I got to do 10 phone calls. What's my funnel look like? What are the exigent events that I've got to threaten in order to get somebody to tip over? Like it is you need a salesperson on your team to structure the activity level, and you just grind. I mean, you have to have a coherent thesis. Somehow you have to have a track record, even though, which means it makes it a lot easier if you're coming from some other fund where you weren't the person who raised it, but you have a track record of investing and you're going to raise your own fund now. They're like, oh, you know how to be a VC because you've done it somewhere else. It doesn't make it easy. It doesn't make it easy, but I think it makes it easier. Craig and I went from entrepreneurs to angels to syndicates.
But you already have phenomenal kind of track record through your businesses and through your angel investing. Wasn't it enough to convince LPs?
It's what got our 200 million AUM in place, but there are other elements: timing, size. Right? You can't really get an institution to participate unless you're raising at least $100 million fund. So micro funds are really under 250. But I think there are, and I wrote about this recently also. It's the power law of VC forces some strange behavior as your funds get larger. At least a lot of where we anchor ourselves is around the entrepreneur. I mean, they are the lifeblood, right? They're really what makes this whole ecosystem work. And if you get misaligned with a founder, like think about this. Everybody reads TechCrunch or sees all the headlines. NVIDIA's value, OpenAI, XAI, like you just like, holy cow, this is amazing, right? Everything's, rainbows and unicorns. This is fantastic. And that is like the top 1% of the top 1% of the top 1%, literally, right? Of what's actually transpiring here. So you really have to have a thematic reason, believable thematic reason for why somebody should give. It's not even their money. They're the gatekeepers on the money, right? Unless you're talking to a family office. And, the gatekeeper on the money has to be like, I'm going to get fired if I screw this up, right? It's not I want to make the most money possible. What's the best strategy for, it's like, I want another sleeve in Sequoia or, and that's not all of them, like anything else, right? But it's a lot of them. And when you become $1 billion fund, in order to return $2 billion or $3 billion, you can do pretty easy math on understanding if you own 20-ish% of a company, how big it has to be and how many of those you need. So if the three of us start a company and we raise, I don't know, 5 or 10, $15 million, and we're growing it from scratch, right? We get people to come work for us for nothing, equity, right? We convince customers to give us, to sign invoices on vaporware because we're almost ready to launch it. We're going to we do all the stuff that's really, really hard to do and balance all these things. and we grow a company to 100 million value, and somebody wants to buy us because we built a cool part of their strategic plan, only in like Silicon Valley land is that somehow a failure. Like, think about that. Growing something to 100 million valuation from your brain, like just a thought, and going out and trying to figure. But if you're a tier one VC and I spent 2 years trying to help you grow and you took 10 or 15 million of my dollars and you only give me back 2x, I have literally wasted my time. And I'm not very happy with you because you had to sign up for the $1 billion exit plus, like multi-billion dollar exit, hopefully. So, but for a micro fund, if I get 10% ownership and it sells for 100 million on a $20 million fund, I just return half my fund with one deal. Like, yay. Like, everybody should celebrate. It's, legacy changing for the founder and, the initial team, life changing for the rest of the employees, really good for me and my LPs as a micro fund, but it's, for a big fund.
So where did you find success in meeting the right LPs? Was it all in US, or you did go to outside of US to raise?
Our funds have been primarily US based for LPs, high net worth, family
From
offices.
US.
A lot of entrepreneurs that had exited. And of course, with Craig's in my background, a lot of people who have some familiarity or understanding with, vets or the military. About half our deals now are into, like not DoD specific, but dual use is what we call it, right? There has some application on the government side. It doesn't have to be DoD. Like eteamz, not specifically focused on DoD, but helps veteran affairs for veterans who need to access, all of their benefits. State and federal governments for stopping fraud from the dark web, from people stealing people's checks.
Yeah. And so you moved to Portugal, right? Kind of. What was the reason to move? Like, sounds like everything is focused around US, and here you are in Portugal. So what is the reasoning?
So in addition to the couple of companies that my wife and I started, she's built, and exited 5 different businesses. We started twins at the same time. So we have boy-girl twins that are 14 and a half years old. And the boy is a very good soccer player. It's at Grant Perdew 10, Grant Perdew 10 on Instagram. He's got, I don't know, like close to 10,000 followers now. But he has been trialing and got offers to play and, please come if you can to Germany, to a couple of Bundesliga clubs in Germany and a couple of Portuguese clubs. So I took my wife and Grant's twin sister to Frankfurt, Germany, 2 Thanksgivings ago, and it was about 40 degrees, dark at 4 p.m., sleeting, and my wife and daughter are looking at me like I'm insane. And then we came to visit Lisbon, and it was sunny, and we sat in Casa de Guia on the rocks and the cliffs, enjoying, fresh octopus, and it wasn't really a fair comparison. So I was like, well, Dawn, maybe Grant, it's time for him, it's time for him to fly the coop. Like, go and board and do whatever he needs to do. And Dawn said, the coop is going with him. So I live in Portugal because of my son and my boss. Right. And my co-founder at Moonshots, has been super flexible in understanding this is a big life event, both for my family. It's also been awesome for me to get networked into this community where I met you and a lot of the other investors here. We have looked at one deal that's Portugal-based that wants to go and launch in the U.S., and that's our mindset around where we would be able to add value, right? It's really important as an investor for us to be able to add value. So any deal that we did would have to have that as part of what their roadmap is for us to be able to want to invest in that.
So now you're open to invest even in European startups that expand to to US.
Oh, yeah.
Okay.
Yes, for sure. So my work day for the U.S. market is 2 p.m. to midnight-ish here, and then I'm on an airplane every 4 or 5, 6 weeks or so for a week for board meetings and meeting new founders. Mm-hmm. Yeah, doing strategy work.
Cool.
In fact, when's this going to air?
Sunday.
Probably like this Sunday.
Well, next Thursday, I'm interviewing a luminary. I can't say who since it's going to air before I do it. But next Thursday, I'll be in New York interviewing a an icon on a fireside chat. So hopefully, I'll have some information I can feed you guys on that after.
Yeah, you shared the story about your encounter with Elon Musk, right? So kind of sounds like you have an amazing network around US, especially, right?
No, Yuri, I'm just old, so I've gotten to meet so many people over time.
Yeah. So so this network helps you get the right deal flow and also capital. So it's amazing.
Yeah, absolutely. The network is absolutely critical. It helps with deal sourcing. So understanding and meeting founders when they know what we like to look at and see and stay front of mind with them. It helps with helping the companies after we invest, from introductions for whether it's a distribution partner or talent sourcing or whatever it might be. It's super useful from that standpoint. And then frequently during, liquidation events, especially during acquisitions and how that process flows, having the right relationships with different acquirers to make sure the right introductions are made and that companies, considered as part of that set, absolutely critical. And then, the founders themselves, it's a very lonely job
Yeah,
being
it
a
is.
founder. And because a lot of our LP network is made up of exited founders, they're willing to talk to our founders, right? Because we hope and we want that the founder would talk to their board member, but it's just like talking maybe to your spouse also, like you don't, or even the people on your team, like every day is up and down so much. Like, first of all, if you shared that with everybody, they'd go crazy. They might lose confidence. They like the stuff that you have to deal with is that very lonely role. We can introduce other founders who've been in that seat, and that empathy is pretty important and critical for helping them deal with it and manage
Yeah,
their way
it
through it.
is super helpful. Cool. I think we are kind of exhausted most of the questions for today. Um, yeah, Nico. Yeah, kind
Cool.
of. Thank you for your time.